Some say be careful what you wish for. All this as Fed member after Fed member says it's not going to happen. So where does this leave us? Let's ask Tom Lee. He is Fundstrat's co-founder and head of research. He is also a CNBC contributor. It is good to see you as always. What do you make of this market reaction today, Tom, to that CPI print?
Scott, I think today's CPI print wasn't like a tiebreaker. I think there was something that people who are constructive on inflation falling, they saw plenty there to like. And then there's people in the sticky inflation camp, and there's plenty of arguments there. So it's sort of been like this all year where it's a game of inches being fought. But progressively, I do think the bull case is prevailing. And if I could just point out, I think one of the biggest implications for this CPI report is the percentage of components that are actually in outright deflation. So if you look at the price level and then where it is now, these are off the peak. It's actually now hitting 40%. That's actually well above the 10-year average of 38% and the 45-year average of 30%. So we're actually sort of saying forward inflation should come down pretty sharply.
Is that your bull case? I was going to ask you, what is the bull case? Is it simply that inflation comes down more sharply than people think? The Fed is absolutely done. We have a soft landing, because that's maybe a lot to ask for.
It is a lot, Scott. I mean, I'd say as some people say, it's a narrow path. What we think is the bull case is that inflation is falling faster than most people realize because we're starting to drop some of the high prints from last year. And that's going to allow the Fed's pause to become more comfortable for investors because it really leads to a soft landing. I still think that's more than a 50% probability. And then when you consider where positioning is, if you look at FINRA margin debt, for instance, there's been more liquidation or deleveraging of FINRA margin debt than occurred in 2008. So people are sitting on cash on the sidelines. Retail money market cash has risen by $500 billion, a lot of it before March, just in the past year. So we've got people sitting on cash. And if we have a soft landing, we know corporate profits have been holding up nicely. So it is a scenario where the bonds are at 3.3% for the 10-year. That allows PE to expand, and that's why stocks could go up.
I know, but speaking of sitting on, using those words, the Fed is likely going to be sitting on higher rates for some time. And even some of the more, let's say, dovish members, like Austin Goolsbee, for example, says he's already getting, quote unquote, vibes of a credit crunch. So if it's higher for longer and we've already got some credit issues coming into the system, that doesn't sound that bullish to me.
No, it doesn't, Scott. Higher for longer would be tough because, again, there would still be a lot of tension between those who think something will break and those who don't. But what I would point out is that another scenario could emerge, and I think it comes from both the public's outcry about high rates and political pressures, is that the Fed could end up tolerating inflation settling around 3%. I know Powell's publicly dispelled that notion, but that does explain why, the forward curve is where it is versus where the Fed tells us interest rates should be. That I think there could be a point where the Fed could end up tolerating something around low 3% inflation. That would be quite good for stocks and profits. But I'm not saying that's the probable case, but I think that's why things could get better.
You think they end up cutting this year? Is that in any way part of your bull case?
We don't. I think one reason why the Fed futures are forecasting cuts is people are assigning a probability of an emergency from a regional bank crisis. I mean, that would not be good for stocks, but I think the bond market is trying to price that in. I don't think anyone in the bond market really thinks there's actually interest rate cuts coming, but they also don't think we're going to be at 5% for the next 10 years. So I think the 10-year kind of stays anchored in this low 3% range. I don't know where the 2-year ends up, but it's really going to be the 10-year that really drives where PE should be for the stock market.